It's just honor. Okay. Okay, good morning, everybody. I want to thank everybody that's here for braving the elements, even though from what we're being told, it's going to get worse before it gets better. But anyway, we'll call the meeting to order. Item number 2 on our agenda this morning is a resolution of appreciation for Francis Kersey. And as Mayor Holt did the other day at the council workshop, I will have the pleasure of reading the resolution for Francis for her service to the ERS. Whereas the Oklahoma City Employee Retirement System and the Board of Trustees were established by Ordinance 8169 in January 1958, and the board was tasked with administering the retirement fund. And whereas Francis Kersey has served as Secretary of the OCERS since 2002, whereas Francis has performed her duties with professionalism, dedication, and a keen attention to detail, always striving to educate herself on topics relevant to the retirement system, whereas Francis has been recognized during her tenure as an expert in the Open Meetings Act, Open Records Act, and has worked to protect the OCERS by ensuring we follow the state statutes, and whereas Francis led the city and all its governing bodies in quickly adapting to effectively conduct business during a pandemic, whereas Francis has streamlined many processes benefiting the OCERS, such as the implementation of an open records request system and 2 agenda management software systems. Whereas in 2017, Francis received the Sunshine Award from Freedom of Information Oklahoma for her contributions to openness in government and for promoting the free flow of information. And whereas Francis has performed her duties as Secretary to the Employee Retirement System with excellence and has always in the best interest of the members. Now therefore be it resolved by the trustees of the Oklahoma City Employee Retirement System that they do hereby gratefully recognize the contributions of Francis Kersey and thank her for her professionalism, leadership, dedication, and guidance during her 19 years of service to the Oklahoma City Employee Retirement System, adopted by the trustees and signed by the chairman of the Oklahoma City Employee Retirement System this 11th day of February, 2021. Before we vote, would anyone on the board like to bestow further platitudes on Ms. Kersey for her long tenure of service? Because I'm going to, so I'll let someone else go first if they want to.
Mr. Chairman, I'd be happy to. Francis is, I call her the ultimate gatekeeper. She has kept me out of trouble so many ways, and I know I've frustrated her in so many ways over my 30 years here at the city. But Francis has always been extremely professional, and you know that she had your back at the end of the day. And telling people no sometimes is a hard thing to do. We're not going to do it that way. We're going to do it this way, and it can rub other people the wrong way. But Francis has just always been so professional. It's been a pleasure to work with you. I appreciate all the things you've taught me, and you're going to be missed. And but thank you. It's been a pleasure.
Thank you, Trustee Bryant.
Anyone else?
Chairman, I would. Francis, just thank you. It's almost been a year I've been with the city, and you've been instrumental in helping me get onboarded, get up to speed, and really a lot of insight on being new to the public sector. And I greatly appreciate you, and I wish you all the best.
Thank you, Trustee Madeira.
Well, I've been here 33 years, and Francis and I have been not only associates, but I think we call each other dear friends for that extended period of time. Francis and I were on the first board of directors for what is the Oklahoma City Employee Association, that we pay our 50 cents a pay period for our dues. It was Francis, myself, Laura Johnson, Susan City, who at the time was Susan McNitt, the city auditor,
Debbie Farrell Lynn.
Deb Farrell Lynn, Mark McWinney, Chris Fote, who still works in the IT department, and Joyce Plunkett, who's now retired. And was Tony Francisco on board too?
I don't think so.
He's the treasurer down in Norman now. Or is he the finance director? He's finance director, okay. But that goes way back to probably 88. So I'm dating myself, which is not unusual these days, but I mean, France, I don't have to tell you anything. It's just remarkable. You've been a great help to everybody here, especially me. In my duties as a chairman, and all those years I worked in Public Works, and our volumes of agenda items that before the automated management system, we used to have to carry stacks of agenda items with manual buck slips that everyone had in like triplicate. You had to sign them and rip off a page and give it to the department, and then they'd route them around. Anyway, we've come a long way, and we truly appreciate your service, and I personally am going to miss you, but I know that we'll see you. We used to go to lunch, some of that original board of directors, we used to meet for lunch every month, and then when the pandemic hit, we stopped, but we're sure going to fire that, that monthly lunch date up again after things get somewhat back to normal. So again, thank you so much, not only for your work, but more importantly for your friendship.
Thank you, Mr. Chairman Bronson.
Okay. So with that, Chair will entertain a motion. Have a motion and a second. Please record your vote. I'm looking to see if it. Here we go. Approve unanimously. And there's your official copy.
Okay, thank you all very much.
One more standing ovation.
Okay, after all this recognition, I don't know if my head's going to fit going out the door. You all may have to push me. But thank you. This is my last public meeting, so you all have always been very special to me. It's been a pleasure to serve with you on this board, and I will miss when the conferences are back in person. I enjoy getting to know you all personally during that time period. So thank you very much for this recognition. It means a lot to me, Paul. Thank you.
You're very welcome. And not to let the moment get away from us, Amy Simpson has been promoted as the new city clerk. She's been our purchasing agent for how many years? For 10 years, and she's now taken on the huge task of being the city clerk. So the next time we get together in person, she'll be sitting here next to us. So congratulations, Amy. We look forward to working with you. Okay, moving right along. Item number 3 on the agenda is to approve the minutes of the meeting of January 14th. I have a motion and a second. Please record your vote. Item is approved unanimously. Okay. Item number 4 is the consent docket. We have 4 items that we can take with one motion. Have a motion and a second. Please record your vote. Items approved unanimously. Item number 5 is to ratify approvals. We have 2 items that we can take with one motion. Have a motion and a second. Please record your vote. Items approved unanimously. Item number 7, no, I'm sorry, item number 6, getting ahead of myself, is the claims docket. Have a motion and a second? Please record your vote. Items approved unanimously. Now we're on item number 7. Item number 7 is to approve the following applications for service retirement. Have a motion and a second? Please record your vote. Items approved unanimously. Item number 8 is to approve continuation of pension to the spouse. We have 2 items. Have a motion and a second. Please record your vote. Items approved unanimously. Item number 9 is to receive the report of death, authorize payment of the $5,000 death benefit, and authorize secretary to make necessary changes to conform on the following. I have a motion and a second. Please record your vote. Items approved unanimously. Item number 10 is items for individual consideration. Item 10A, we are going to strike from the agenda.
Call a motion.
Wiley, go ahead.
I would like to inform why we're striking the item. We had negotiated a contract with RSM, and they wanted to put in a clause to limit liability for their work. And we normally don't put those in our contracts. And then they added a language that said it was only based on their gross negligence. Well, that's an impossible standard to justify most of the time. And it's just, in essence, means there is no, everything is limited. We wouldn't be able to collect any damages, most likely. And so I pushed back on that, and then they told us yesterday that they would not agree to strike the word gross. So I'm recommending that we move on with one of the other bidders that we are in the RFP process. And that's why we're striking.
Does anyone have any questions? Okay. I have a motion and a second. Please record your vote.
Thank you for your work on that, Wiley. Appreciate that.
Yes. Items approved unanimously. Item number 11 is the investment consultant report. Item 11A is the monthly investment report. Jason, good morning again.
Morning. Before I get started, I just want to say that I've enjoyed working with you, Francis. It's been an honor. I've learned a lot myself, getting to spend time with you at conferences as well, and wish you much luck. It's in your retirement. Thank you. So this morning I have a couple things. We'll go over the January report, and then I really want to talk about asset allocation going forward and some minor, what we view as some minor tweaks, but just recognizing where we are and just being realistic in terms of forward-looking expectations as we've come off a 10-year period and certainly a 2-year period where market returns and portfolio returns have been much more than what is expected. And it leaves us at a point where valuations are pretty rich and yields in the bond market are pretty low. I'm not going to touch on the quarter report, but I will tell you, just as we as I make those comments, your 1-year return for calendar year 2020 of 16.6% outperformed your policy index by over 400 basis points, or over 4%, and placed you in the 9th percentile of public pension funds, meaning you outperformed 91% of other funds. So it's a really good portfolio returns and results. The last 2 years, just to give you some context, 2019 and 2020, the cumulative return over that 2-year period is about 37%. So if you think about what your assumed rate of return is, of now you've been conservative and thoughtful, I think, in lowering that down to 7%, that's really about 5 years worth of returns, a little more than 5 years worth of returns pushed into 2 years. And when you think about it that way, it's telling that going forward, we're probably not going to look like that as we move forward. And really, over the 2018 was a down year, but 2017 you were up 16%. So we've had three of the last 4 years have been very strong. And when you see our forward-looking capital market assumptions, particularly for the next 5 to 10 years, much more muted. That said, results have been very good. You haven't just gotten what the markets have delivered. Your active managers across the board have really added value. Looking at the January report, January was a bit of a tough month, down slightly, a little less than 1%, really coming on the equity side. And there were some things going on in January that I'm sure many of you have heard about, seen on the news, and that have really impacted things, specifically with the Wall Street bets and this Reddit app where a lot of traders, not necessarily all retail traders, but certainly a populist movement of people trading and pushing up names that had heavy short interest. And if you think about what that means, heavy short interest is companies that don't look very good in terms of their fundamentals, have a lot of shorting going on, meaning hedge funds and other institutions are making investments in those companies with the anticipation that their stock price will go down. January, through the social media and other platforms, pushed those companies' stock prices up, forcing people that were short those names to go in the market and buy them, and pushing those names up further. Just to give you a little bit of insight on that, within the small cap universe, so the Russell 2000, this is astounding, and you'll really see the impact within your small cap portfolio was actually down 37 basis points, and the index is up almost 2.5% for the month. The companies in the index that had greater than 20% short interest, that makes up 3% of those 2,000 companies, greater than 20% short interest, meaning these are the most hated companies in the index. We're up 74% in January. The companies that had greater than 10% short interest, which made up about 20% of the index, were up 18% in the month. The highest return on equity companies, so companies that are really providing a return on equity investment, were down 7% for the month. The highest dividend growth companies were down 5% for the month. Dividend payers down 1% for the month. So you see, we really saw a month in which fundamentals really didn't matter, and that had some impact during the month. Much of that has corrected in the first few weeks of February. We saw fundamentals coming back and a lot of those names coming down. That said, there's potential for a little bit more volatility in this area. Over time, however, we do believe that fundamentals matter and will matter and will win out. But I think it's important to recognize what's going on. It's not poor performance from managers necessarily. And you really look at your small cap and the long short equity, which you have fundamental based managers in both of those areas that are picking stocks that they anticipate will go up based on the quality of those names, really suffering. Within the long-short equity or the Mauna Kea platform, there was one manager that did have some exposure to GameStop, South Point, which makes up about 4% of your long-short equity portfolio. GameStop was a position in that portfolio. They were short GameStop. They were able to get out fairly early in the month of January. It cost them about 48 basis points for the month. So some impact, but I know Regina had called me and was asking me questions about this. You know, like everywhere in your portfolio, the Mauna Kea platform, the long-short allocation, we have significant diversification across managers and across positions. So we wouldn't expect any one position to have major impact. But for the month, certainly seeing that companies with short interest being bid up dramatically, having an impact. And again, like I said, what we've seen so far in February, at least the first week and a half or so, is a rebound in that. Nonetheless, your one-year return through the end of January still up 16% versus your policy index up 12.6%. So very good returns across the portfolio. In the month, if we just go back to page 1, looking at the asset allocation relative to targets, equity, because of how much equities have run up, are a little bit over the target and slightly outside the range at 66%. We did raise cash from small cap, Times Square, just last week? Yeah, today. Oh, today. It's happening. $10 million, so we're bringing that down for cash needs. But as we look at the asset allocation analysis we're doing, one of the things that what we're proposing is to actually bump up your policy target from 60 to 65% in equities and lower your fixed income target from 25 to 20. That's not to get the current allocation in line with targets. It's based on our forward-looking assumptions and how challenging it's going to be to get the 7% return over the next 5 to 10 years. We think you need to take a little bit more, have a little bit more in equities to get there, and we'll touch on that. So when we look at that, it's always important to separate the policy target discussion from actual implementation discussion. So while from a policy standpoint, it may appear that we're making some significant moves, from where you currently stand, we're not proposing much movement of money, because a couple of the areas that are currently underallocated, and one area which is real estate, and one area that we're proposing to bump up in lieu of the reduction in fixed income is private equity, and it will take some time to get there. So we'll come back to that. Any questions on the monthly report before I turn to the asset allocation? Okay, thank you. So hopefully you all had this piece. If not, I think Regina has some extras, this asset allocation discussion piece. So slide 3, just some bullet points. So I think I've been mentioning this and having this conversation at every client meeting so far this year, where we come in talking about how fantastic results are, looking in the rearview mirror, but much more cautious looking forward. I don't have to say this to you all. You have been very realistic and conservative in your forward-looking expectations, and done a good job of lowering that assumed rate of return from a funding and liability standpoint. But it's important that we review this and confirm where we are, revisit the targets, but also focus on the long term. If we get too bogged down on where we are today and looking at the next 5 to 10 years, we are missing the bigger picture, and that these assets are intended to fund liabilities way into the future. You know, we're funding liabilities for the new employee that's just coming on, not just for Francis that's going into retirement today. If you turn to page 4, this will just start to set the table for where we are in terms of our intermediate term assumptions. So each year, we reconfirm our capital market assumptions, and we develop capital market assumptions that we call intermediate term and long term. Our intermediate term assumptions are really looking out over the next 5 to 10 years, whereas the long-term assumptions are now looking out 20, 30 years plus. The intermediate term assumptions are anchored more on current valuation and current yield, whereas the long-term assumptions are anchored primarily on long-term historical averages. So that said, this chart on page 4 kind of gives you some insight into our intermediate term assumption. This isn't the sole building block, but what this chart is telling us is based on the current valuation or price to earnings multiple on the S&P 500, where have the returns been the next 10 years based on that starting point in terms of PE. So if you look on the left side of the page, the horizontal axis is the PE on the S&P 500, and the vertical axis is the trailing 10-year return following that point in time. So what this is showing is when the PE on the S&P 500 has been around 10 times earnings, the next 10 years, the returns have been roughly 15% or more annualized over that 10-year period. Where we are today is way over here on the right. The price earnings multiple on the S&P 500 at the end of the year is just north of 30 times earnings. And it's really not been very often, but when we've seen the PE on the S&P 500 that high, historically, or even out in that neighborhood, the trailing 10-year return has been somewhere between -2 and 2.5%. So pretty muted returns, to say the least. And so when you look at our intermediate term assumption for large cap equities, it's 5.9%. So it's in this neighborhood. There's some other factors that go into that. It's not solely based on valuation. There's an inflation component and an earnings growth estimate that goes into that. But from a multiple expansion standpoint, we're at a pretty rich starting point. That said, I think it is important to keep in mind there are pockets of opportunity for investors to generate return within equities. If we think about the S&P 500, 50% of the return in 2020 came from 5 stocks: your Facebook, Apple, Amazon, Netflix, Google. The other 495 were basically flat to slightly positive. So there are pockets of opportunity within the U.S. large cap market, but overall, we're starting from an expensive standpoint. The other side of the coin on fixed income, starting yield or the going in yield is the biggest predictor of trailing return over the next 10 years. So this chart is telling us a similar story for bonds, particularly U.S. investment grade bonds or aggregate bond strategies. If you go out on the far right on this page, where yields were, this is the yield on the aggregate benchmark. This may be hard to remember. This is the early 80s with yields up around 16, 17%. Really, since that time, we've seen yields just come down, come down, come down. And it's been a pretty good period for bonds overall. As yields have come down, bond prices go up. But today, and really we've been saying this for 10 years now, when yields were at around 4%, that was all-time lows. Well, now we're at yields on the aggregate or the 10-year treasury slightly over 1%. So what that's telling us, we had our starting point today is almost off this chart. Really, you see how far extended it is from where things have been. Expectations for bonds going forward are pretty challenged, pretty muted. Now, we have been doing things in this portfolio for some time to mitigate against some of this, to primarily to add some other return drivers within the fixed income portfolio without necessarily taking on equity market risk. But that said, there's only so much that can be done there. It is important to maintain and have bonds in the portfolio to provide protection in more challenging market environments. But as we look at the overall mix, can we do some things to help buffet the return a little bit? And at this point, it's really adding to equities, and you'll see that. So the next slide is really intended to be just a simple illustration of how we look at things going forward. While expectations for stocks and bonds are lower, the relationship in terms of risk and reward between stocks and bonds and cash hasn't changed. We would still expect to be compensated more for investing in bonds over cash, and you would expect to be compensated more for investing in U.S. stocks versus bonds. And as you move out in risk, you would expect to be compensated a little bit more. Small cap stocks, non-U.S. stocks. We don't show on here private equity or venture capital. We don't show on here real estate, which would fall somewhere in between bonds and stocks still. But the starting point is just lowered. The risk-free rate has gone down. So all asset classes expectations have gone down, but the relationship remains similar as it has historically. That said, within equities, I touched on just opportunities within U.S. We didn't highlight it using the term value or growth, but we've really seen a long period of time where growth has outperformed value. We started to see in the fourth quarter of this year a bit of a turnaround, particularly with the positive vaccine news, really helping some of those more economically sensitive sectors, financials, industrials, and others that have been beaten down pretty bad. That lasted through October, November, and into December. We really think there is, value is not dead. I mean, we're getting this question more and more now. It's the same question we were getting in the late 90s when people were asking, why are we investing in value when growth stocks and technology are up 100%? Well, we saw what happened, and things are getting pretty frothy now. We have always maintained the philosophy of trying to be style neutral and not take bets too far one way or the other. And so we would continue to maintain that across the board, domestically and outside the U.S. What this is intending to show is a similar phenomenon that we've seen over the last 10 years that does impact our relative return assumptions between U.S. and non-U.S. stocks to some degree. The chart on the upper left is showing the shaded area above the line is periods of time when non-U.S. stocks have outperformed U.S. stocks. The shaded area below the line is when U.S. stocks have outperformed non-U.S. stocks. So what you see here is this is cyclical. It moves over time. The last time we saw U.S. stocks really outperform, or non-U.S. stocks outperform U.S. stocks was following the bursting of the tech bubble in 2000, 2001. And you had a pretty sustained period of 6 or 7 years up until the financial crisis, the end of, or the coming out of the financial crisis, where non-U.S. stocks outperformed U.S. stocks pretty substantially. Since that point in time, U.S. stocks have had a pretty sizable advantage. And I'll show you the 10-year returns, it's pretty dramatic. We think that's pretty long in the tooth, and as a result, some of the non-U.S. markets are a little bit more attractively priced. That also tends to correlate strongly with the strength in the dollar. So the chart on the lower right is showing the U.S. dollar relative to a basket of foreign currencies. And it's the opposite here on the bottom. When the shaded area above the line is above the line, that is, the U.S. dollar is strengthening relative to foreign currencies. When that happens, that's a headwind for U.S. investors investing outside the U.S. because even if your stocks you're investing in go up, it costs more to buy back dollars when you sell those investments. When the dollar weakens, which you'd see from that 2002 to 2010 period, that correlates pretty strongly with the period of time that non-US stocks were outperforming. That started to abate more recently and fluctuated around neutral, but with the amount of stimulus and debt the US government's taking and really trying to promote inflation, get that inflation target up above 2%, we could see this as starting to happen again. And so that feeds into our intermediate assumptions for international. So the next page is our assumptions, along with what we've actually experienced the last 10 years. So the very top line is large cap equity, and you'll see that over the last 10 years, US large cap stocks up about 14%. That's certainly above what our expectation was for large cap stocks if we went back 10 years ago. That was above our intermediate assumption. That's even above the long-term historical average, which is around a little over 10%. It's come down a bit, but it's a little over 10%, the S&P. Our intermediate term assumption for large cap stocks is about 8% below what we've experienced the last 10 years, whereas our long-term assumption is still right around 10%. Small cap stocks, a good decade, up 11%, but on a go-forward basis, certainly much lower expectation, but more attractive than large cap, 7.8, and then long-term at 11. You'll see international and emerging markets, the last 10 years have been pretty challenged. 6% for developed or EAFE benchmark and 4% for emerging markets. Our intermediate assumptions are slightly higher than what we experienced over the last 10 years, but relative to large cap and, or really relative to large cap, a little bit more attractive, and then longer term, the same. Long short equity, the intermediate assumption is 4.8. When we think about what we're doing, and as we reduce bonds, we have 10% of the equities. We have had, and we continue to maintain 10% of the equities in a lower risk equity allocation. That's really what this is intended for, is to get a premium return to bonds, similar return to equities, but lower risk. It's helping to manage some of that downside risk. But then we look at bonds, and you see our intermediate and long-term assumptions both below your 7% target. So this is really where the rubber meets the road, making it much more challenging when holding bonds to get to where you're trying to get. But we can't abandon that. So simply on the next page, I'm sorry, there's not a page. Either I wrote on page 9, we show our analysis. So the first column is your current policy target. This is your policy target, 25% to bonds, and you see how that's split up, core plus, global, and absolute return. Then your equities overall at 60, 20% US large cap, 10% small, 10% international, 5% emerging, 10% long short, and 5% private equity. And then real assets, combination of core real estate, which is your Morgan Stanley component, and then opportunistic, which are more of these closed-end type funds, Starwood, which you just made a commitment to, the Sigler Guff Distressed Real Estate Fund, and TA Associates. Those are private market vehicles, just like private equity. You make commitments to fund those. It takes time to get them funded. The second column, well, you'll see, I'm sorry, sticking with the target, you'll see where that 10-year median return falls to now. So the 50th percentile probability over the next 10 years for that asset mix is a little over 5%, 5.13%. Below your 7% target. But this is where we're saying we need to be realistic. There's not a lot we can do in the intermediate term to get that to 7%. There's really nothing we can do short of just taking all equity risk, which would not be prudent. The one measure of risk is volatility or standard deviation. That portfolio mix comes in at 10.3. As we look out further in time, over a 30-year time horizon, and this is really what's more appropriate to determine if your assumed rate of return is realistic, you'll see this asset mix is the 50th percentile probability, which is the median, is at 7.5%. So it's realistic. If we looked at 20 years, 20 years is going to come in somewhere in the middle there, though. It's going to be about 6%. The way our model works is it uses our intermediate return assumption over 10 years, and then it blends the long-term assumption in over time. So the further out in time we're going, the more it's going to assume the long-term capital market assumption. The intermediate term is more just for decision makers to have an idea of practicality and reality, if you will. The current is how you're actually allocated right now. This is not a policy mix. This is simply how the portfolio has fluctuated based on market movement. And we show that there are a couple things. The things that are the most underweight are real assets. You're not at your 15% target to real assets because it's, we're just not there. We're at 10 and we just can't, you can't simply move money into real estate like you can other asset classes. Equity is slightly overweight the target, and that's primarily US equities as they've run up quite a bit. And fixed income is a little bit below the target. Then we show two alternative proposed mixes, both of which lower the fixed income target by 5% and increase the equity target by 5%. Actually, from where you are today, it would bring your equity down a little bit in terms of, from a target standpoint, but the policy, it's bumping that up. But what would go up is still, from where you're current, is still the real assets, and we can't really get there. So mix one is simply taking 5% from fixed income, kind of across the board, across the different buckets, and adding it to private equity, increasing private equity from 5 to 10%. I didn't touch on this, but really you've been building your private equity program for about 10 years now, since 2008, and it's taken us that long to get to 5%. We think 10% for a plan of your size at over $800 million with long-term liabilities is certainly reasonable. We wouldn't have modeled that 10 years ago because to get from 0 to 10 takes so long. So just being more realistic and having a 5% target. Now we think bumping that target up and building to that helps. You're adding to an asset class that, from an expected return standpoint, private equity is the highest expected return in the intermediate term and long term that you're utilizing today. Mix two just makes a slight modification to that from a target standpoint, and also takes a little bit more from large cap, bringing your large cap down from 20 to 18 from a target standpoint, and reallocating that from a policy standpoint, bumping up international and bumping up emerging markets. And we get it's a slight bump up, but more from in the intermediate term, it's just a reflection of our expectations that non-US are a little bit more attractive than US. Also, just an acknowledgement relative to the global market cap, the global opportunity set today is about 55% US stocks, 45% non-US stocks. 10 years ago, that was closer to 50-50, and because US has done so much better, that's bumped up. Your allocation between US and non-US in your targets is closer to 60-40. If we're just looking at the long only, not capturing what's in long short equity and private equity, which there is some, but you're at 30 and 15, so it's like 2/3, 1/3. This would bump that up a little bit closer to neutral. So our recommendation would be to adjust your policy targets to reflect mix two in the policy. The actual movement of money would be pretty de minimis right now because you see where you're at 67% in equities. That's of this. We've done some of that just by moving money. At the end of January, you were at 66. This would put you within your target ranges today. But the things that are going to be underweight, private equity would be about 5% underweight. Emerging markets is already at 6. International developed, so that's Harding Loevner and Lazard, would be slightly under the target. We could move some money from the S&P 500 there. But it's really your private equity and your real estate that is underweight. Just as a reminder, you in 2019 and 2020, so the latter half of 2019 and in 2020, you made $46 million in commitments to private equity. There's still $36 million of that unfunded. So we are building that. And that was really with the target of 5% in mind. So what will happen going forward, we're not done. We weren't done at 5%. At 10%, the bite size might go up a little bit in terms of commitment dollars that we have to make to get to 10% within a reasonable time. On the real estate side, since 2013, now that's going back a little bit further, we've made $30 million in commitments to opportunistic real estate, which is really what's underweight. You're at 1%. 15 million of that 30 million was just made, just closed on that with Starwood in the last, and none of that's been called. So we are making progress toward that. So again, the recommendation would be to adjust the policy targets to reflect mix two. That would be a policy change. In the short term, I don't envision significant movement of money, and other than what we normally do for rebalancing and maybe a little bit from large cap US into international developed. So we've normally done this in 2 steps. We kind of get the understanding or approval when we review the asset allocation. If you're good with this, we would come back next month with the policy document reflecting those changes in the policy document.
Does anyone have any questions for Jason?
Is my mic on?
Yes.
Just a comment, Mr. Chairman. For what it's worth, I think this is a very strong recommendation, and I highly encourage it. So,
Okay. Anyone else? Okay. So right now, we don't have to take action on this. This is just information. Well, yes, we do.
Well, yeah, we would come back with the document, the policy document, red line, reflecting the changes. If you're in agreement with it, I guess.
So, given the information that we've just received and Randy's recommendation, and I agree with that too, the chair will entertain a motion to allow Jason to come back next month with the policy documents to allow us to move our allocation to mix 2.
Mr. Chair, the motion needs to be just to receive the report and that the consultant was given direction on how to proceed, but you can't vote.
Okay. So the chair will entertain a motion to receive the report and the recommendation provided by Jason.
And so that's covered by that as deemed appropriate, and possible action as deemed appropriate in the, okay.
Okay, I have a motion. And a second. Please record your vote. Approved unanimously.
Okay.
Okay.
So we'll come back next month with the policy document to reflect the revisions in mix 2.
Okay,
Oh, well, I guess I won't, I guess I'll do that via
Zoom,
Zoom, so.
via Zoom.
I understand going back to that, so I'm very happy I got to see you all the last 2 months. Kind of a cameo appearance once a year. But,
Okay, did we address item B, the quarterly?
yeah, I touched on it.
Okay, okay.
We need a motion to receive A.
I need a motion to receive items A, the monthly investment report, and item B, the quarterly. I have a motion and a second on items A and B. Please record your vote. Approve unanimously. Ma'am. There we go. Okay. Okay. Next item is item number 12, comments from board, staff, and citizens. Counselor?
I haven't been able to do this, but I wanted to take a moment and tell Frances how much I've appreciated working with her over the years, and I appreciate all the help that she's provided, and in dealing with me in last-minute requests to get on the agenda, and I just can't thank you enough, and you know I will miss you a lot, and I look forward to working with Amy in the future. Thank you.
Thank you, Wiley. And you noticed he had quite a distance, so I wouldn't lop off his head while he was talking to me. Thanks, Wiley.
Okay, on item 12, just to update the board, we have about concluded our selection process for what's the title of the position? Retirement Systems Specialist. That's the third position that we've been kicking around for a number of years now. We worked with the Human Resources Department. We received 50, I thought it was 58. We received 58 applications. We did an oral review board a couple weeks ago for 11? 9, okay. And we've screened that down to 5. And next week, Regina and I will be interviewing both in person and via Zoom those 5 candidates. We have some very strong candidates, very strong. So that's good news for the board. But hopefully by our next meeting, we will have an announcement as to who we've made an offer to, and hopefully that person will accept the offer. So that's where we are on that. Anyone else for the good of the cause? If
Mr.
not,
Chair, I would like to say, I think this meeting has just been a perfect microcosm of the strength of this board and all the people involved. Frances, you, as always, stepped up and kept everything going, and I've really enjoyed working with you the past 30-some-odd years. And Randy, your input on the investment mix was very much appreciated. Jake, you guys looking forward and just like seeing the horizon for us, it's incredible. And Wiley, your work on the accounting contract, and I really appreciate that. And Regina, you pulling it all together. It's just amazing. I just sit and look around this board and think about how fortunate we are. I just appreciate all you guys.
thank you, Jim. Okay, we are adjourned at 10:54.